All right. So as part of our presentation, I looked at the rally in North American markets, starting with the S&P 500 and NASDAQ indexes after both were sharply lower in 2026. You can see there the S&P 500 down 19.3%, recovered year to date up 16.9%. Similar, the NASDAQ down 33% in 2022, started with a bang. It's the recovery has been more pronounced on the NASDAQ, where it was more pronounced in terms of a downturn over the 2022. And in 2022, that was really a historic decline. As we can see on the chart here, however, the tech-driven exchange has rebounded year to date, up now 33.8%. Again, not clawing back all of the losses, but a significant percentage. But it is a tale of two markets. The gains in 2023 have been driven largely by 8 stocks known as the Mega Cap 8: Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, Nvidia, and Tesla. They alone account now for over 26% of the S&P 500 and roughly 50% of its year-to-date returns. 8 stocks powering the total return of the 500 stocks in the S&P 500. The remainder of the index and the smaller cap companies in particular have not fared nearly as well. So let's look here at the broader valuations first before I get into that and a potential opportunity. Now, broadly, one metric we like to use or look at when we look at the broader markets is the valuations is the Shiller PE. It is a more reasonable market valuation indicator than the regular PE ratio because it eliminates fluctuations of the ratio caused by variations of profit margins during business cycles. Now, here's the Shiller PE over the last 20 years. It reached its highest point right here, November 2021, in the range of 38.6. That would be 47% higher above the average PE of the last 20 years, which was 26.2. Now, the highest ratio that it has reached in the past, that was the highest ratio it's reached in the past 20 years. Now, this is looking back over about 100 plus years. The highest point, that point was only exceeded once, and that is in the dot-com madness right there in 1999 at roughly 44. Now, where are we today? That should be the next question here. Well, valuations today, we look at the Shiller PE, it's roughly 31.1. That's 18.7% higher than that 20-year average I talked about, which was 26.2. And that is far better than the range of 38 that it was hit in November of 2023, which was 47% above the PE of the last 20 years, the average PE of the last 27 years, or 20 years, sorry. However, it is instructive to point out that the Shiller PE is still 79% above its all-time average. Its all-time average is 17.4. That indicates we are not historically cheap or hysterically cheap either, but mainly historically cheap. It's better than the peak, but the market remains bifurcated. As far as the forward-looking regular PE on the markets to transition to where we are on a forward-looking basis today, it is a tale of two markets in terms of valuations. Now, this is a simple chart. Well, kind of looks simple. Kind of looks like a plate of rainbow spaghetti to me, but it shows the disparity between the large and mega cap stocks represented on the red and purple lines, respectively, and between the small cap universe. That's represented by the green line here, and that is following the S&P 600 small cap index. Now, I'm going to just give you the broader forward-looking PEs on these three indexes. S&P 500 large cap is at 18.5. The mega cap 8 is 28.1. The S&P 600 small cap is 13.8. So larger caps and the mega cap 8 are trading at significantly higher multiples than the S&P small cap 600. To give you an idea of the constituents of the S&P small cap 600, to be included in this index, a stock must have a total market cap of ranging between 850 million to 5.2 billion. So that tells you what is considered essentially a small cap stock in the US via this index. Drilling down on small caps versus large cap story, the valuations here, this is since 2005, the S&P 600 has historically traded at a premium to their larger cap S&P 500 counterparts. But we can see today small caps trade at a significant discount to their large cap peers. Again, this chart highlights the discount here. It's pronounced and likely presents a long-term opportunity if you're looking at quality, growth-oriented small caps. So the question is, what should you do today? One thing you can do is just focus on what you can control in your portfolio. That would be number one, the construction of portfolio. This is how to build your portfolio, how many stocks you own, over what period to build it, and when to adjust and review your portfolio. Well, you can get that advice by coming to one of our live webinars on demand. Find them at www.keystocks.com. We'll show you the simple steps of how to build a 15 to 25 stock portfolio. And I talked about that briefly in the presentation at the Money Show. But number two is also just the composition of your portfolio. What type of stocks you want to own in that portfolio. Those are the things that you need to focus on right now. Now, I'll tell you what we're avoiding in the market. We just looked at over 3,000 companies in the US and what we're avoiding when we look at these companies. Near term, I would not recommend buying the index given the valuations, but fortunately is not a market of stocks. It's a stock market. There are still select companies that are growing that look attractive. Now I can go into what we're looking for and what we'd avoid today here. What we'd avoid is, or what we'd really look at is to pay attention to the balance sheet, particularly cyclicals with heavy debt. This is where you can really get into trouble in a highly leveraged company. Interest payments have gone higher and they're eating into profitability. So companies like restaurants, hotel chains, airlines, furniture, high-end clothing retailers, automotive manufacturers, these type of cyclicals, look at the balance sheets closely when you're looking into those businesses. Now, this doesn't mean that strong cash flow producing businesses with debt, you should eschew completely right now. They are fine if they're producing strong cash flow. But we are favoring cash-rich businesses. These are stocks with a net cash balance on their balance sheet and they're producing strong cash. Yes, we want them to be able to weather a downturn, but that's not the sole reason we look at them. We want them to be able to profit from it, make acquisitions in times when they see other businesses on sale. Now, an example of this I'll give you from our research, and I talked about them at the event, would be Dynacor. It's about 33% of its market cap in cash, zero debt, and a profitable business. Another example I can give you is a company we've talked about a number of times now is Hammond Power Solutions, HPS.A on the TSX. Huge cash flow in 2022. It went from a net debt to net cash positions. It can expand now organically and through acquisition. Now, what is Hammond Power? Well, they are a leader in the design and manufacture of custom electrical, engineered magnetic, standard electric, dry type, cast resin, and liquid filled transformers. Those are not Autobots and Decepticons, although that would be seriously cool. The transformers that Hammond Power makes are used to step up and step down travel to step up over a long distance and then step it down for an application such as to bring it into your home or a charging station. In fact, every Tesla charging station in Canada has a Hammond Power transformer. For years, we have seen it as a backdoor way to play the electrification boom. When we recommended it several years ago, it traded in the $7 to $8 range, and that was a re-recommendation. It was trading around 7 to 8 times earnings. That is real earnings, not an adjusted basis, versus the many obvious electric vehicle or EV plays like charging station companies and EV manufacturers that then traded at ridiculous valuations if they even had underlying cash flow. Now, Hammond Power had decent growth in its core business, but as the world electrified, our thought was the growth could increase. Now, that has followed, particularly over the last 18 months, and the stock has followed. It still trades at 11.5 to 12 times this year's expected EPS. Hammond is a good example of one of the type of unique opportunities we scour the markets to uncover for our clients on a daily basis. With the smaller, growth-oriented business currently trading at relatively attractive historical valuations, there may be some longer-term opportunities presenting themselves to find the next Hammond Power and help you produce outstretched returns over the next decade. And that's what we try to do on a daily basis for our clients in their portfolios. So hopefully that makes sense. That's a snippet from what we talked about at the Money Show. Any comments on
Yeah,
that?
no, I find it interesting how, on one hand, the market overall is so much more expensive than it was historically on a historical comparison, yet small caps actually are not, at least not to
Yes.
the extent. And if you go back 10 years, are actually, at average to below average levels of
Yeah.
valuation.
Yeah, and then the it's flipped. There was a premium for
Mhm.
well over a decade and beyond that in the teams of and especially in quality oriented, growth oriented small caps in that range. Like we're not talking about a $50 million market cap on the TSX Venture as a small cap. You're talking about 800 plus million up to the 5.8, I think it was, $1 billion market cap. So, many of those are high quality businesses, growth oriented, just considered smaller cap companies in the US market. Those, because of the fact that they're, have the ability to grow at a better rate historically than, say, a company with a 500 or $1 billion or $500 billion market cap. It's easier to grow a business when you have smaller numbers. Now, they traded at a premium. It's flipped. They're trading at a discount today. A lot of that is powered by the massive multiples you're seeing on some of the mega cap 8. But overall, the small caps, even removing those mega cap 8, they are trading at higher valuations than the large caps are trading at higher valuations than the small caps. So it could be an interesting time. That doesn't mean you rush out and load your portfolio with small caps today, and you shouldn't do that at any time. It can be a balanced part of an overall portfolio, and that's what we recommend to our clients. And again, it's got to be cash producing businesses, good balance sheets, good growth ahead of them. But having some of those in your portfolio will likely be a benefit to you over the next 10 years.